So it's great. It's with great pleasure that we welcome Demetrios Zoppos today. Demetrios is an ex-McKinsey consultant, ex-World Bank associate. He's an ex-successful entrepreneur. Now he's an investor, and he's going to talk to us about his amazing journey.
Thank you, Pano, and thank you, Anna. Thank you, everybody, for inviting me here. I asked Ioannou to give me some guidance as to what I should be talking about. I can talk about lots of things, but I thought, I'd better ask what to focus on today. And they said, look, students here love a good story. They like kind of personal story, what you've been through, maybe sort of get some lessons. So I thought, maybe start with this, which is never let truth get in the way of a good story. Mark Twain was an insufferable individual. He came up with all these quips. So I thought we'll start with whatever I say today, treat it as a good story as opposed as to being kind of the truth. And I was a bit apprehensive about this because obviously we're in a university here. I thought the pursuit of truth is the ultimate aim here. But hey, this is tech startups. So a good story goes a long way. So what I thought I'll do first, I'll say a bit about myself first, kind of my journey, what I've done so far and why it might be relevant for what you guys are doing today. And then jump into, I thought I'll give you maybe 10 lessons from my journey so far. So my story is that whilst I've had sort of a semi-corporate career to start with, I went to university, I was an economist. I started with economics as my undergraduate, and then I did public policy at postgraduate level. And then I spent a few years being a management consultant. I worked with large corporations, helping them think through strategic choices. And I worked in sectors like the oil and gas sector. I worked in consumer, sort of supermarket retailing. I worked in commercial banking, did lots of things. And then I thought this was kind of the late 1990s, beginning of 2000s, when the internet was just starting to take off. It used to be called Web 1. So around about sort of late 1990s, early 2000s. And I thought, look, this is something really big. This will change the way we live. It will have a pervasive impact in our lives. So I jumped ship. I left the safe world of McKinsey and consultancy, and I did my first startup called GFX. It was a global freight exchange. It was a marketplace for trading air freight capacity. It was effectively airlines and freight forwarders conducting trade between themselves, making bookings for air cargo, what flies in the bellies of airplanes. This process was completely not automated. It was done by phone and fax and typewriters at the back of rooms around the airport. And we thought we'll build a business-to-business marketplace. And B2B marketplace, as they're called, in those days was all the rage. The first wave of the internet, of the impact of the internet, was automation in B2B sectors, stuff that you don't see really as consumers. It's stuff that happens by businesses for the ultimate benefit of consumers. So I did that for a few years, and we saw every crisis you can imagine. We had the airline crisis, we had the dot-com boom and bust, we had the Asian SARS, another pandemic before COVID, and we even had 9/11. If you recall 9/11, all flights everywhere in the world stopped when that happened. And I was in an industry that worked with airlines. You can imagine that my best finance client had 15 days of cash before going bust. It was a catastrophic event for the industry. So we saw it through, we saw all these ups and downs, did a few more things, and then I ended up sort of doing onefinestay, which was, this was in the sort of 2010s. It was a hospitality marketplace, this time a consumer marketplace, where we bring together people that are homeowners, people have homes, and we let guests stay in their homes for short stays for a period of time. Think of it as being an Airbnb with a service wrapper. It was an upscale, kind of 4-star price point. We tried to reimagine upscale hospitality, how it feels to have a great time for a period of time and have sort of a home away from home. We exited that business in 2016 to Accor Hotels, and I did then sort of Klevio, which is an IoT startup, quite different. It involves electronics, involves building actual sort of physical technology. It's about opening doors with your smartphone. So that's still going. But in the meantime, I was also involved as an investor. I've done a lot of angel investments across different sectors, places like fintech, like Plum, consumer fintech, and also Virgil. I've done travel. Impala is a travel API for hotel bookings. Harry, HR tech, US company. Zoe, health tech, very interesting. It's about the human microbiome and personalized nutrition. And Zen Cargo, again, with my experience with freight, I try to help there as well as an investor. Again, caveat here, so someone's sort of personal experience is not something you can always study academically in large numbers. It's kind of n equals 1. So my caveat is that my experience doesn't mean that what I say today is truth. It's one perspective, and I hope today you learn what you want from it. You hear some things, and maybe some things will resonate with you and be relevant for you, but don't take everything as truth. Listen to many people, not just one. The latest thing I'm doing now has much more relevance to Cyprus. I thought I'll try and contribute more also to the Cyprus technology ecosystem, and I'm building 33 East. 33 East is it's the first venture capital firm focused on Cyprus. We won a competitive bid to have the European Investment Fund involved in this. They'll be the major shareholder, and we'll also raise private capital, and we'll start investing in Cyprus startups, in the Cyprus ecosystem, hopefully from the middle of this year onwards. And 33 is to be focused in the sort of pre-seed and seed stage. So really, really early stage, which is kind of the stage I have quite a bit of experience in. I've teamed up with my business partner, Ioannou, and I'm hoping to kickstart that off as soon as possible, but hopefully starting to see kind of concrete startups from as soon as we can, really. So that's my journey so far, and I thought that we'll jump straight to, I try to distill things into kind of 10 categories of lessons to maybe sort of present, and then have a conversation, open up for questions, which I think might be more interesting for everybody. How many of you, by the way, are interested in startups and interested in tech? Just raise your hand. How many? So quite a few. And are people kind of engineers, economists? What's the computer scientists? Who does comms? Computer science or engineering? Economics? Okay, great. Thank you. Okay, so if something's not clear, just stop me. I'll try and sort of go through it fairly quickly and then give enough time for Q&A at the end. Now, first things first. Most people think of startups as being kind of, what I should do and how I should build it. I've got an idea, I've got a gadget, I've got something I want to do. Very rarely I hear people think about, why am I doing it? And that's something which is absolutely critical for people. Why you want to do something must be front and center before you start doing it, or during the very early process of considering whether you want to do it or not. So most founders I know talk about their idea and they're obsessed with it. They try to iterate it. They will do a lot of work. Some people even raise some money to try and sort of take it to the next level. But no one actually talks about motivation. Why would you personally want to do this? Is it because you want to make money? Is it because you want to have more control over your life? Do you want autonomy? Is it because you want glory? And everyone to remember you as kind of the Elon Musk or Mark Zuckerberg. Is it glory? It's really important, some motivation, not so much that some motivations are better than others or more valid than others, but it's really important to understand why you're doing it, because things are not going to be linear. You're going to encounter a ton of problems, and if you don't understand why you're doing something, it's very hard to stay the course. And the third point here I was going to make is that it's usually a good idea to make it a much more of a gating decision. Don't just jump into something because you've got a product or you think you have a product, but do it because of deliberate reasons and gate it and say, what are the things I need to believe in, see, analyze, to tell myself I'm ready to go into tech startups. Now, one positive thing, though, is that founders come in all shapes and sizes. You might think, I'm not cut out to be a startup, I'm not cut out to do startup. It's not true. People come in all sorts of personalities. There's introverts, there's extroverts, engineers, there's business people, there are people who have just ideas. It comes in a very wide range in terms of the personality of the founder. What does matter, though, is to be considerate and thoughtful. And my suggestion is always to make it into a gating decision. Think through, do as much as possible, just yourself with a small team, not raising any cash, and use that time to really consider as to why you want to do it, and write it down. And then open the box after a few months, after a few years, and think, am I still doing it for the right reasons? Lesson 2. Another classic mistake is that people think that product. You think of your product, your area, the thing that you know really well, or better than you think than other people. But you ignore the market. And this is exceptionally typical of people who are really more kind of technology-oriented. They look at what they've built, the code they've built, the website they've built, the gadget they've built, and they don't really think as to what people want, what the market wants. The market is a great leveler. As soon as you bring something to market, the market hits you back with a punch like you've never seen before. It tells you information, tells you things you need to listen to, you need to learn. And what I've seen is that there's always a temptation to be product-led. And when you launch something, you say, the market doesn't understand me. The venture capitalist doesn't get me. It's okay to be arrogant, but it's really, really important to listen to what the market tells you. And I feel that a lot of people underinvest in validating their product. To give you an example, say with my startup onefinestay, we spent quite a bit of time thinking through, in particular, how homeowners would feel about giving up their home to some random company they don't know. Their most valuable asset, millions of pounds worth. Why would I give my home up? And we spent quite a bit of time thinking through doing focus groups, recording them like now, and just asking a group of 8 to 10 people, asking them sort of random, sort of open-ended questions. How would you feel about if there was a service that did this? Would you put your home up? Would you do this? Would you feel comfortable doing this? Would you give keys to people? So on and so forth. And we wrote things down, and we read it and read it again and all that. And interestingly, after we exited, after years of work and fighting the trenches, I went back to those transcripts to ask myself, what did I not hear? What mistakes would I have not made had I actually listened to very carefully as to what people told me? And I can tell you, 99% of all the problems we encountered, people told us. They told us. They just didn't say it very loudly. Some people said it very quietly. And it was a footnote somewhere. This person said it kind of, I'll be comfortable, but I need this. We didn't hear those things very loudly, and we made some mistakes nevertheless. But I feel that some people don't put any work in validating, either at the micro level, talking to individuals for a consumer product, or kind of doing interviews with businesses to say what you really need. And my point here, the establishing point, is talk to the market. Get more data from the market. The answers are there. And the final point here is market sizing, which will be a theme in lessons here. Market sizing. People think it's enough to say, it's a big market, it's a huge market, worth billions, and if I have a product that takes a small slice, I'll be successful. Don't do that. Spend time understanding the market. What is really your addressable market? Who really will buy it? So how much, what's the size of really the addressable market in your case for your service or product? Third lesson. I talked to in the last I would say, week, I've spoken to at least 3 startups in Cyprus that are starting new things. And every single one I talked to told me, I'm building this, and what this is typically is a very wide-ranging product. It's trying to be all things to all people. So my advice is focus, focus, focus. So if you think you're focus it, twice more. Your temptation will be to under-focus in everything you do. You'll try and build something with lots of features, lots of bells and whistles, and whether it's a product or a service, it will typically be very wide-ranging. And my preference is always to go deep and narrow as opposed to broad and shallow. There's always a temptation to go very broadly because you don't know what you're looking for, right? So basically cover everything and then see what catches, right? But it's really important to be very deliberate about what you do because you have to look at the data, what the market tells you. So if you start somewhere very deep and narrow, it doesn't work, cross it off after a period of time, start something new. But don't go all things to all people because that's a sure path to success. It will never become a thing that's focused. The other thing is kind of, most people don't consider what is the actual customer buying. So say you go to a law firm, you want to buy some legal services. What are you buying? Are you buying advice? Very rarely. Most people are buying an insurance product. They say, if I get sued, I have the lawyer kind of written memo report. I have the tax memo that I won't be sued. I won't end up in jail because my lawyer told me to do this, for example. So legal service could be just an insurance product. Also, what you build. Are you building something because it will make a consumer's life more convenient? Are you doing it because it will be a cheaper price? Would make things easier and simpler? And generally speaking, the rule of thumb is build stuff that's 10x better, at least, than the nearest competitor. But to do that, you have to understand really what is the motivation behind what somebody's buying. And what you think you are selling may not be what the customer thinks they're buying. And what you communicate to a customer may not be what the customer hears you communicate. So this stuff is very complex, and most people who are very product-focused don't spend enough time understanding really detailed motivation, human motivation, be that a consumer product or a business line. And finally, point about organization. The reason you focus is not just because of this kind of market, the interaction between the market and your service. It's also because if you don't focus, when you're a small, tiny peanut of a company with a handful of people, you cannot focus your own people. They'll be everywhere doing all sorts of different things you don't want them to be doing. You want to focus organizationally, have a single thing and deploy everybody's effort in that one single thing. If you have 3 things, good. If you have 1 thing, it's even better. Just 1 thing at a time. Focus, 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 I keep saying. The 4th point, I know that you've had others of talks here about PMF, product market fit. This is kind of the magic word in early stage startups. It's basically, is what you're providing, what you're producing, what the market wants? It's almost like a negotiation between you as a supplier and the market as kind of a demander of your service. And it's like a porpoising. You build something new, you get some information, you get some feedback. But product market fit, whilst a great concept, there's no metric for it. It's not you can measure it, can take a temperature measure and say, do I have product market fit? It's a judgment call from you. Do you think you have product market fit? I mean, obviously, there's kind of evident things. If you have it, you know it. It's just that if you don't have it, you don't always know it. So, for example, if something is flying off the shelves, you probably have product market fit. People are buying instantly what you're selling. I remember when we first launched our very first offering at onefinestay, we had literally 2 pages of results. We had 10 homes. We had 5 pages per home. 5 homes per page in the results. Only 3 of those homes of the 10 were actually available. The other ones would be our own homes. And if somebody came and stayed, would leave, and we did that. We're going from playing Tetris, moving from place to place in the town to test the service. And the first week when we launched it, all the inventory was just gone. People bought it. Next week, we put 1 or 2 homes, and that was also gone. Did you have market fit? Maybe, maybe not, I don't know. It was indications, positive indications. But guess what? Month after month, the more we put, the more got sold. End of the first year, end of year 1, we had a 500% year-on-year growth. I mean, that was obviously probably second year, 300% year-on-year growth. Third year, 100% year-on-year. So this stuff here tells you the market is pulling on you. It's clear that what you're offering is there. But again, caveats. Why is it going off the shelf so quickly? Is it because you're underpricing? Is it because you're overselling? Are you spending too much on marketing? It's very easy to convince yourself that you have that fit between what the customer wants and what you're selling, but maybe you're looking at the wrong metrics. So it's always important to have reasons why you think, analytical reasons why you think you have that market fit. And the other point I was going to say is that this is mantra, the kind of the Silicon Valley mantra, move fast and break stuff. It's kind of the Mark Andreessen kind of school of thought where speed is of the essence and time is a biggest killer of the best ideas. You've got to get stuff to market really quickly, but you have to have at the back of your mind market fit. There is no point in going and raising a ton of cash and scaling things if the kernel of what you have doesn't have market fit. Why? Because it's much cheaper to scratch something and test something different before you raise a lot of money, before you step on the accelerator. So prove something in a lab effectively before you go and raise a ton of cash to scale it. And finally, I say this all the time, use PMF as your voice of conscience. It's your secret friend telling you something, whispering something in your ear, whether to do something or not to do something. It's something which is really important to have at the back of your mind all the time, even when it scales. The other kind of rubric of lessons is about people. And this, I would say, is one of the most kind of critical corner pieces in early stage tech startups. Great trade-off, of course, is great team versus great idea. What would you choose? A great team or a great idea? Great teams will pivot. They'll change view if an idea that they're looking at, working at, is terrible. If they don't have the proof points, if they don't believe in it, if they don't have the facts, if a prototype doesn't quite work, scratch it, do something new. Kind of a great idea, even an average idea, cannot be rescued by a misconfigured team. And I'm not talking about sort of bad teams here. You might have great individual people, but the team is just not working. You may have a wrong co-founder. You might have a wrong skill set. You might have a very important early skill set missing. So it's really important to think about composition, especially sort of co-founder selection. When you're starting something, who is your co-founder or co-founder? Who is the sort of starting team? Really, really important. You have to think through. There's lots of things you can read about this stuff, about technical co-founders with kind of business co-founders, and depending on what the idea is and all that. Again, there's various sort of shapes and sizes, but there are sort of norms in terms of what's good and what's not good. Having small teams, co-founding teams is important. Having sort of designated roles is important. But I would say this. The early team build, making wrong decisions on team at an early stage is lethal to a startup. I've seen this in Cyprus recently where they say, okay, I'm going to bring this guy in because he's a commercial, I'm a scientist. I'm going to have this idea, great idea, and I'm going to bring the commercial guy to run this. When I hear this, I know it's just not going to work. It's simply not going to work because typically the co-founders have in their mind a destination, they have a vision. They are the owners of the product vision. It's not something that's outsourceable easily. So it's a different thing to be an entrepreneur versus being a startup, like a chief scientist. So my point is that early team build, if you make a mistake, reverse it as quickly as possible, ideally before you raise lots of money. And finally, a quick point about friends and advisors. I actually found the best advice randomly through friends. So surrounding yourself with people that you can listen to and sort of go and sort of bounce ideas off is really important. But those people, I can tell you, are not, the best ideas will not come from people you expect. They'll come from different people. So spend time sharing ideas with people you don't expect to get ideas from back. Because you will find every now and then the odd gem. Lesson 6 is more about the same theme, the market. Go for large markets and big ideas. Having a tiny slice of a huge market is much more rational in tech startups, in fast growth startups, than going for ideas that require you to have effectively a 50% slice of the market to be successful. And why do I say this? Because there's many ideas which are great. I love many ideas. Which I hear about, but they can never be scale businesses. When we talk about tech startups, one of the most important things is that it doesn't really mean it's not about tech. It's about deployment of things with near zero technology risk. When I say technology risk, if you are doing, for example, electronics, you're not going to reinvent a chipset. True R&D happens much earlier. When I talk about technical risk, there isn't really much technical risk about implementation of existing technologies. Therefore, when we talk about tech startups, what we're really referring to is high growth businesses, things that can start from a small crystal and become huge. I mean, Uber, what technology does Uber use? Mobile telephony, GPS tracking, it's pretty standard stuff. The internet stack for distribution, this is not like reinvention of the wheel. We're not inventing a wheel here. We're deploying existing technologies. Even AI, a lot of kind of the large-scale language models or machine learning things are basically deployments of existing infrastructure. You're not kind of reinventing kind of the method by which you do that. You might have embellishments, different parameterization, but you're not actually reinventing the wheel in AI. Why am I saying that? Because the risk category for the much earlier R&D stage is a very different type of risk. And those things are in the realms of research. And that's why we have academic institutions where you deploy public money typically to solve problems with no particular solutions that have a commercial angle. Whereas tech startups involve themselves at the later stage where you're trying to commercialize these technologies and bring them to market, build useful stuff that people want to buy. So back to this addressable market, having a large market is not enough. It has to be addressable, and you have to analyze it and understand which of this market really is your target market. Again, back to the example of kind of one-finestay and say short stays, we could have said the world's our market, like travel is our market, international travel is our market, but it's not quite true. The segments, is it families? Is it families with kids? Is it individuals? Is it business? Is it leisure? Which segment is the addressable segment? We focused on one segment to start off with and then branched out, but we nevertheless thought this very analytically, just from the start thinking, it's one segment we're focusing on, and therefore we are pitching our product, our service, just for that segment. It doesn't mean you don't want to go to other segments, but it helps you really focus and get that 10x better than anyone else in the market. And the final thing I was going to say, don't spare ambition. Being ambitious does not mean being deluded. It doesn't mean being kind of completely deluded and thinking that you can achieve something that no one else can achieve. But it means that going for very powerful implementation of very simple ideas, but thinking expansively, thinking that, for example, if you wanted to do this and you require 20 million of capital, still think through, okay, let me go and raise 20 million of capital to get there, if that's the constraint. If the constraint is hiring the best person who knows how to do this, ask yourself, what do I need to do that? Have an open mind, be ambitious, don't constrain your ambition. Think of the vision first and work backwards. Don't start from what you have, start from what you can imagine. The other thing I was going to say, which again is back to this kind of market theme, and I would say this is especially important in Cyprus. Smaller market where the average company size here is generally small compared to very large economies. When you go to and pitch your idea to a business here, say if it's a B2B product, they might tell you, yeah, but I want this and this, and I want the complete, to buy from you, I need a complete product. I want this 25 bells and whistles. Otherwise, I'm not going to buy it. Fair enough. But remember, to scale this in the larger market, the opposite is going to happen. You're going to have to narrow down. So you're basically getting a client at the expense of your scalability. So if your ambition and your vision is to build something, say, Europe-wide, then your Cypriot small medium-sized business is not your target market, is not your ideal customer in the sweet spot in the early stage. So think through how can you get access to your target, your real target market that you're selling to. Who is your real target market? So I keep saying this about sort of market politics, especially in B2B, understanding the structure, conduct, performance of an industry, thinking strategically as to how does it work? If it's a marketplace, is the supply concentrated? Are there many players or small number of players in one side of the market? Is the demand side concentrated? Is it a consumer market? We've got millions of customers on the one hand and small number of businesses. For example, in my first startup, GFX, we had the wholesale air freight industry. Very small number of airlines, worldwide about 50 airlines, quite concentrated, and very fragmented freight forwarding. The buyers are very fragmented. And yet the conduct wasn't really oligopolistic, let's say, on the airline side. It was much more competitive because the forwarders were quite concentrated at the very top end. The top 5 were quite concentrated, but a very long tail of small players in the local market. So the forwarders had a lot of power in particular markets against particular airlines because the market wasn't really a global market. It was multi-local. Every origin-destination pair was a market in itself. But of course, to understand that, you have to sort of go into that market, analyze, understand the politics, what motivates pricing, how does it work? And getting an understanding of that is super critical, especially in B2B. In consumer, you can assume things are more competitive. It's true, although you have some issues, especially in digital media, where you have some concentration of various players. So for example, I see a number of opportunities for, say, startups where people say, yeah, I'm building this, which to me sounds like a feature of Twitter or a feature of Facebook or a feature of Google. Great, but you build this, you want to charge for it, and it's free or not available yet, but Twitter can tweak something, and then you have your feature is on Twitter, on TikTok. So you have to be very careful to understand the industry, politics, and the wider ecosystem. Lesson 8, understanding financing. Early stage tech startups, this sort of pre-seed and seed stage, is typically venture-backed. So venture capital firms typically finance and provide the fuel that rockets these ideas into high growth. But to be able to be in that space, to be in this game, you have to understand how venture capital industry works. Like the one I'm trying to build now, the venture capital firm I'm trying to build now, the business model for these types of funds is we invest in a small number of ideas at early stage. So if you've got a fund, say, a 50 million fund, you'll probably invest half of the fund in, say, a handful of companies, say 20 companies, right? And then hold back half the fund to invest in the winners, in people who scale nicely, and then not invest again in people who haven't proven that they can go to the next stage. So you double down on the winners effectively. But for me to have the conviction to invest in any of these 20 companies, I have to believe that each one of them individually can return the fund. So returning the fund means if I have a 50 million fund, I have to get a 3x on that fund or 2.5x of that fund from just a single investment. So I invest $500,000 or $1 million in one of these 20 companies. I have to believe that company can become 200 million business. Just one of them. Which means I have to have a conviction that each one of them can be a 200 million business. I will not be investing in great ideas which can become nice little profitable businesses but will never scale to become 200 million of value. This is a critical point. That's understanding the financing businesses you are working with, you're raising money from, to understand their business model. This is not the business model, for example, of private equity firms that invest in large, typically established cash flow generative businesses. It's a very different business model. So as a startup entrepreneur, you'll be interacting with venture capital firms. You need to learn how that model works. Also angels. Angels are very different. Me as an angel, putting some cash because I like a startup and I want some return, that's non-institutional money. You don't play the same game. You might lose some, you might win some, you do it because you like the founders, of course you'll get a return, you might be able to contribute to the startup, very different motivation. So typically, raise your first money from friends and family, from angels, to bring to the next stage, so that by the time you get to VC, you have something that's a bit more proven, perhaps better valuation as well. It's an art though, not a science. And also think, how do VCs evaluate you? VCs at pre-seed stage expect great team and an idea. Same at seed stage. Team and idea matter much more than anything else. It doesn't matter more than traction. Obviously, by the time you get to seed stage or later seed, you need traction. You need to show that you are getting market fit. Later stage, post-Series A, it's more about the numbers. Traction matters more than idea, but team still matters a lot. And of course, later stage becomes much about metrics. It's all metrics driven. By the time you get to Series D, do you have the unit economics? Is it getting profitable? Are we generating cash here? But unit economics matter much less at seed stage than they matter in Series C, Series D. But VCs will always look at team and idea really important. So if I see a team that basically I know I cannot back at Series C, they won't scale with the business, even though I might like the idea, I won't invest. And that's the truth of it. Another point here about culture and purpose. Now, it's a bit of it's becoming a cliche, right? Culture, everyone wants to work in a nice environment. It's not about that. It's about having cohesion between what you're building and the people who are building it. And it's much easier to rely on culture and purpose than to rely on process. I mean, if you go to large companies and you work in any of you have seen some of the guts of large corporations, they all kind of run on process and they're kind of depersonalized. You don't rely on an individual or a purpose. But startups don't typically work like that. You work very hard typically. You have multiple roles. You don't have sort of focus roles. You might be nominally a founder, but you might be doing like a bit of CFO, a bit of marketing, a bit of coding. You'll be doing sort of calling customer support in the evenings. Everybody does everything. So having kind of that kind of common purpose, hiring people for personal qualities is really, really important. And having that kind of drive as a personal quality is really important to designing kind of a culture that's suitable for early stage. The other thing I was going to say is simplifying and designing for scale. So as you scale, it's very, very important not to get into the world of more and more process. This is a very typical thing. When you reach certain sort of magic numbers, typically when you reach a team more than 20 people, things change. And then you feel again at about 150 people. So that's sort of magic number where you have to put a bit more process, a bit more structure in place, but hopefully not too much, and still retain that kind of early stage feel to things. But as you scale out the number of people, what tends to happen is that you get more specialists and more kind of also general managers. Whereas early stage, you have more generalists in the business and less specialists. And I call this kind of culture as glue. It's what is a substitute for process and structure. And by the way, this is kind of common across, it doesn't matter whether you're starting as a software startup, selling a software product to businesses versus being kind of a social network, or doesn't matter what it is. It's about the people who are in the company. Final lesson here is about personal growth. It ties a bit in with the first point, which is that I'm not sure that many people think about this. How will entering this world change you? And are you willing to do that deal with yourself where you want to change, you are willing to learn? I find people who are quite malleable and open to learning tend to do well in these environments. They have this kind of learning mindset where they're open to ideas, they listen to people, they change things and all that. But asking yourself, how will this change you? What will you change? I know about myself, for example, I like problem solving. I like solving problems, I like building products. This stuff I don't particularly like doing, but I knew from the very beginning, I got a sense that if you want to do this thing, if you want to be a startupper, you really have to be able to change in ways that you might not like. You might be quite introverted, you might have to sell to people in a B2B setting. Yep, okay. You might need to maybe fire people as something scales. You might not like conflict. But I'm just talking about wider things as well here. You will do stuff and be involved with stuff because you have to do everything. There'll be, through that sort of personal journey, you will be MacGyver. You'll have to do absolutely everything under the sun. And I've done this in every startup I was involved with. I didn't know anything about the industry. I was very naive, but I was open to learning. And then I did every single job in the sun in each of those startups. And again, for me, I always say, are you ready for this? It's a lifestyle choice much more than it is anything else. You've got to choose to want this because it's not for everybody. So choose it actively. Don't let the fact that you have an interesting idea choose it for you. That's it. These are sort of the 10 lessons. But I wanted to open the floor for any questions.
Well, I have two questions, basically. The one is regarding the first slide, I think, where you were talking about before that, yes, exactly, here.
Thank you.
If I understand correctly, there is a wide variety in markets where you decided to get involved. What motivated this broad range?
Interest, because at early stage, the specific market is much less important than, I think I have functional knowledge of early stage.
Okay.
A lot of these businesses look very similar at early stage. It's like when you look at kind of slides under the microscope, you look at tissue cells under the microscope, many cells look the same. It could be animal cell or human cells, they look very, very similar. It could be a fintech startup or it could be a health tech startup, but the guts of it are quite similar. Very, very surprisingly similar. So, and also if you think about sort of the factors of success, they are very similar factors of success. Hiring the right people, product market fit, focus. It's the same across all these things. So early stage, there's kind of certain sort of playbook that if you do things right, it doesn't really matter what the segment is. And interestingly, many of these founders I've talked to, all these, maybe except one, all these startups here where I'm an angel, and I've got another sort of, I'm probably an angel in 20, 30 startups and a couple of funds, but these ones in particular, the founders, none of them were from that industry. Victor at Plum, he wasn't a fintech guy. He did some fintech before, he was more of a kind of marketing guy. Virgil, he was hospitality, doing fintech. Harry, general entrepreneur doing HR tech. Zoe, George was doing travel, and then when Jonathan did kind of health tech. Zen Cargo, Alex was a kind of a private equity guy, and he's doing kind of logistics. So a lot of this stuff is about business building and startup building, not about the functional side of things.
But rather the ideas.
Sorry?
But rather the ideas.
Yeah, the idea. For example, take Alex at Zen. I think he came up with the idea as being on the finance side, looking at the industry, things like that. Ideas come from everyone. Remember, ideas are worth very little. It's about executing on those ideas and having kind of the deliberate chance of doing it. And a lot of people have the same idea, but doing it is really important. So listening to what the market says and all that. And then you learn about the market as well.
The trickiest part that you, in your experience, found in terms of noticing it and also not falling for it?
Like a pitfall.
Yes.
Look, I would say when it comes to culture and people, one of the most complex things is people. People are not machines. We operate, we have our own AI, we make our own stupid decisions. Very hard to predict how people operate. So when you're building teams, typically, in my experience, when you have to make a tough decision, this person's not working out, I need to replace them, or I need to hire someone in this role, those types of decisions, typically you are 3 months late. By the time you make the decision, you're always 3 months late. You should be hoping that you're not 6 months late. But if you're 3 months late, you're okay. So in my experience, people and people-related stuff is the hardest thing. Because think about this. When you have a scaled-out conglomerate with 20,000 people, 2 or 3 people leaving or changing doesn't make much difference. Maybe at senior roles, maybe some difference. But if you're a team of 5 and one of the people leaves or doesn't work out or is creating trouble or is not working alongside other people well, it's death for the company. So taking those early decisions is almost like forks in the path, and some of them are just random. You make the decision, but it's important to be decisive about people. That's my, I'd say, biggest lesson for me.
Another one.
Yeah.
Your co-founder, what's the trait you most want him to have and the trait you don't want him to have?
Very good question, exceptional question. The trait I always look for is drive. People who are driven, tenacious. Things change. Situations change. COVID happens. Disaster. 9/11 happens. Stuff happens. Shit happens in life. Okay. You want people alongside you who will be shooting with you in the right direction. That's really important. So, and for me, the single most important sort of driver of that is determination, drive. I call it drive. It's kind of we can go into more detail around what I mean by that. But effectively, it's people who don't give up, who keep trying, who keep trying to do certain things, are positive about it, have a positive outlook, a learning outlook, but they keep trying. So eventually you'll get there. But if you don't try, the denominator is nil, the success is going to be nil as well. You have to try many things, and then hopefully you play a stats game. But the drive for me is the most important thing. And then the second question, what I don't want to have, that's a harder question. I think varies by role, but in terms of a co-founder, I don't know. I mean, personally, I just want people who are, I like people who are kind of like ideas-driven, smart, curiosity. People who are not curious tend to not want to solve things. And these types of things are quite early stage, very high risk. They have distribution of outcomes could be very wide. So if you've got people who are not curious alongside you, it may not work out very well.
The best way you found to notice, actually, the best way that you found to notice whether he has drive and whether he's not curious?
Very, very good question. I thought about this. I thought about this very deeply, actually, in a structured way. How do you interview? How do you basically how do you test for all these things? I used to do a number of things. I used to do case studies when I interviewed people. I mean, co-founders are a bit different because you have to spend time with them. The best thing for co-founders is to work together. The biggest de-risking factor is to spend time working together. So my advice to people who are thinking, is my co-founder good? Spend weekends, evenings together working the idea. Get a whiteboard some things out. How about this? How about that? Do some prototyping, do some hacking together. Work with each other for long periods of time. Put some effort, put some skin in the game, basically. That de-risks things for you because you'll know, do I like this person? Am I getting on with them? Is it easy? If the interaction is always difficult, it's not right. And you have kind of a sixth sense about it quite early on. And doing that work also de-risks it for you, so you don't have to sort of change things around before you start. But when you hire people later on, so early team, for example, the way I did that is I always did sort of case studies followed by team doing interviews as well and case studies, followed by a working session together. So what we tended to do is that, because all of us have biases, we would have a structured sort of interview process with a case study, and then would each sort of select kind of one or two attributes of what to focus on. But the case study would typically be about sort of problem solving. So all of us had to sort of work on problem solving, and then we'd test other things as well. Like, for example, we want to find stay, we had sort of certain number of things we're looking for, but different startups have got sort of slightly different sort of brand values that they're looking for in terms of the team. But the way to prevent the bias from happening is that you listen to what the team says as well, and you have a working session afterwards, because then you learn how it kind of mock how you'd be working together, mocking it up, kind of do a fake kind of let's work together for sort of a half a day. You cannot do that, but what you could do is perhaps work for a 1 hour working session around a certain problem, see how that person thinks, how they interact with other people and all that. I had several examples where I thought this person is great, and then 3 people came to me and said, terrible, can't work with this person. So what do I hear? Presents very well, but doesn't work with other people very well. That's an example. So these things are things that you can put in place afterwards and think about through. But for the founder selection, the best mitigant is to work together.
First of all, sorry, I missed the start of the presentation.
The start was Mark Twain. I'll put it back. Remember, never let truth get in the way of a good story.
That's very nice. But I wanted to focus more on your path.
Yeah.
I mean, you went from a corporate career to the startup world, right?
Yeah, I wouldn't quite say corporate, but yeah.
Or like from a big...
Yeah, professional services, yeah.
Yes. Okay.
Yeah.
So I wanted to ask you about this transition.
Yeah.
Obviously, it's a big change. You must have been thinking about it and had to add some elements in place for you to make the step. For you personally, what were these elements? What was the minimum kind of structure you had where you said, okay, I can go for this, I can do this transition?
Good point. Look, I think these things are first and foremost personal decisions in the sense that you're thinking trade-offs. Do you have a family? Do you have another half who also has a job, a life, something else? Are you willing to work like 16, 20-hour days and not be around and all that? Obviously those things, your ambition, what you want to do with your life and all that. For me, the stuff I really like about consultancy, it was generalist, He was covering lots of sectors. Very interesting. I worked with smart people doing interesting stuff. I really enjoyed my time there. But I viewed myself as being quite practical and a problem solver. I wanted to solve practical problems. I was intensely frustrated to give a recommendation to a client, only see them not do anything about it or do very little about it, or kind of use it as a kind of rubber stamping thing, saying, oh yeah, the board agrees with that, and nothing happens, right? Opportunities, but no one kind of pursued them. So for me, the frustration was the lack of practicality and the kind of more detached view of doing kind of strategy consulting. So for me, it was much more about, so I love building stuff. So I wanted to do something of that nature, but something that involves working with smart people, doing interesting stuff. So for me, it was quite natural to move into this. There wasn't any, I'm worried I'll be working in an environment where it's terrible. It wouldn't be. I like building stuff. But the issue is the kind of the personal side. Do you have the financial means to do it? Not everybody can do this. Most people go and stay in someone's sofa. I met the guy, by the way, who was hosting the founder of Spotify when he first started in London. He was living on his sofa because he had no place to stay. And I think this is kind of quite common. It's a common thing where you've got to sort of trade off your personal situation with what you want to do. And yeah, hopefully you have understanding other halves, families, friends who can support you. Yeah, but for me personally, that was the journey. It was more about, so look, I really want to do something else that's more practical.
So did you wait to identify potential founders?
Yes,
you had the idea?
So the team of us at McKinsey at the time, who we actually looked at various sectors, and we did that. We worked together for weekends and evenings, and we spent sort of time doing that together to see who would work with each other. And then we plucked up the courage to say, yeah, we're leaving, we're doing it. And that's, you have to admit, it's a scary moment. It's not an easy thing to do.
Yeah.
But I tell you, for you guys, any of you here, to decide to do something really risky, there's no risk for you. Okay? The risk largely comes from your fear.
Don't leave school. After school. He means after school.
No. I would tell exactly the opposite. I would say exactly the opposite. I say that if you want to leave now. But my point is that do it deliberately, do it thoughtfully, because it's not just about sort of whether you leave school or not. It's whether or not you fear trying something out. If you fear failure more than you are excited by an upside, you will never do anything risky. By the time you are 30, 40, 50 years old, you have way more constraints. As you grow, you have way more constraints in your life. Things become much more complex by the time you're 50. It's not as if you have unique opportunity when you're young because you can take risks, fail, and there's no issue. If I did McKinsey and then I failed my startup, then take me back, whatever. It doesn't matter. I'll go to something else interesting. Yeah. You have zero risk, but most people don't know this. And also you fear, what do my family tell me? What do my granny tell me? When I was kind of at McKinsey, the mantra in those days was, no one got fired for choosing IBM. And same on a personal basis is that I want my son to go and work for IBM. I don't. I didn't, but most people did. And I'm just saying the same with you. If you do something and it fails, good on you. The culture, by the way, in places like the United States now is that people wear failure as a badge of honor, because failure doesn't really mean failure. Failure means I've tried something. It doesn't mean you are a failed entrepreneur. It's a failed idea. That's why I keep saying market fit. It's the idea you're testing. It's a lab of ideas that you're incubating. It's not about you as a failed person. If this fails, do something else. If it fails, do something else. But if you don't try, you don't have new stuff emerging. You are the guys who build the new stuff. Not all people like me. So this is really important to understand that your risk of failure is zero, near zero. Nothing will happen to you. No one will say, what a terrible guy. People will say, well done to you. Congratulations for trying it out.
Very good presentation, by the way. I wanted to ask something about finance. And what are the investors most looking? Are they looking forward to have an exit strategy and get their money back, or they prefer to have some percentage on the company and they get dividends or so?
So back to finance, the finance lesson. Very different if you're raising from angels or venture capital. angels are not institutional investors. So they typically, of course, they want things to succeed. But when I invest as an angel, I expect to lose the money. And I expect the founder who is taking me on as an investor to know that. I'm there to support the founder. Now, if any angel comes to you and tells you, okay, you came in and you lost my money, they're the wrong investor. I know there's lots of people like that in Cyprus because we are not a mature market on the financing side yet and all that. But you need to go to early stage financing from friends and family for people who back you as an individual who are happy to lose their money. Hold that thought. That's angels. Venture capital is very, very different. As I explained, a venture capitalist invests only in startups which have a chance of returning the fund with that single investment. So if I look at your pitch deck and that cannot become a 250 billion plus business or $1 billion plus business, I'm not going to be investing in. You might have a great idea, you might change the world of kind of cancer research or whatever, but if you're not a scale business, venture capital is not the right model for you. You have to go to another financing class, financing slice. So venture capital is all about pursuing high growth business, and what I expect of you is growth. That's the number one thing I expect. And then profitability. So I want the team to be scalable, I want your idea to be highly scalable, and I want you to be working in large markets with big ambitious ideas because I want your business to become a 200 plus million business.
Okay, so their main goal is to actually the business to grow, and then they will see how the money will come in.
Yes, and the way they evaluate you is that can you be the guy who's going to be at the helm at Series C when you go and raise a 50 million check? Are you going to be the guy, can you convince a West Coast firm to cut a 50 million check for you? Are you ambitious enough to say we're going from 50 million valuation to 250 million valuation in this round? Can you do that? So evaluating you and your idea and what traction you got to get there. So it's a very different concept at Series A than at C. But it's a very similar idea. I want scale. I want people who are ambitious enough to build scale businesses. Not SMEs. I'm not get profitable but small.
Thank you very much.
What do you think of advisory shares? Is it something you do as yourself as an angel?
Yeah. People do that. It's the reason why people first of all give advisory shares is because cash is at a premium when it comes to early stage. So a startup ought not to be paying advisors in cash because it has to preserve cash for things that require for market fit. That's my principle. So I'm happy though to have some upside by sweetening it with advisory shares. Typically that comes also for angels. If you're an angel investor and you're also advising, they'll throw in some sort of share option package for advisors. It's quite standard. And the standard norms in terms of what percentages you ought to give out is quite standard. But it has to be not abusive. It has to be kind of sensible.
On the other side, from a startup point of view, shouldn't you protect your equity as much as possible?
Yeah, this is another interesting thing is that I've seen also, especially in Cyprus, I think also because I think I've seen sort of like more kind of predatory angel would take like large slices of. There's norms, there's market norms. If you go into any website about sort of top tier VCs in Europe or the US, there's norms in terms of ticket sizes for seed and for Series A and all that. There's norms. If somebody comes in and says, look, I'll give you, 50 grand for 50% of the company, it sounds no. First of all, founders have to control the company. You've got to have the majority of shares until much later stage. As it scales, you've got to get to exit by owning at least 10% of the company, at least. But by that time, hopefully it's a unicorn, right? 10% of a unicorn is a very big pie. But when we're talking about early stage, we're talking about dilution of kind of 20, 25%. We're not talking about dilution of kind of 50% plus, whatever the ticket size is. But of course, if you're asking for a lot of money, you've got to have an ambitious plan to show that at that stage your valuation is $1 million or $2 million or $3 million. And that is you. I'm saying I'm evaluating this business based on team and idea. So I better be clear that I'm saying that it's worth $1 million because of you. So that's the quid pro quo. So if it's not really high percentage, then I've got to be clear that you can build this business. On the other hand, though, if somebody comes and insists that, I want 50% of your business, like Dragon's Den style, I can tell you this is rarely going to scale. It's very rare in the venture space that things scale with founders not having control.
But it doesn't work for the investor as well. I mean, you also squash any motivation that these people have.
I agree, but if you go to the Cyprus Angel scene...
If I was offered 50% as an investor, I wouldn't take it.
I wouldn't take it either. But I think this does work in other categories. It works, for example, like when you see Dragon's Den, if you've got sort of a gadget business or a small medium enterprise or a distribution business, those types of things do work. If you've got somebody who has distribution and you have a brand, yeah, copy, paste, do it. But in these high growth environments, that's not the way it works. The way it works is basically 20 to 25% dilution at every successive round with a massive uplift of value in each round. And you only raise when you need to. You only raise when you have the proof points you need to.
So in the beginning of a startup, when you have, let's say, an MVP, and you want to test it to see if the machine is pulling, as you said, and you get the feedback you get the punch from the market, let's say, and you start tweaking the product to get more pull. Where do you pull the line to say, okay, this is my product?
It's an art, not a science. It's an art, not a science. It's the hardest thing. That's a determination by the founder, I think. Sometimes when you have enough conviction that the market is very large and you'll get there, it may be speed is more important than the detail. So that's why I said this thing here in the second slide. Where is it? Move fast versus PMF. Sometimes it's important to move fast and draw a line and say, I've done enough here. But if you tweak something and you don't see things go better, then maybe ask yourself again. It's highly iterative. I'll give you a very interesting example. We're doing acquisition of homeowners for onefinestay. And we tried a ton of different ways of doing that. We did emails, we did Facebook advertising at the time, we did, and then we did also written out envelopes under the door, physically distributed, to say, please come and join us, we have an interesting service and so on. In London, what worked for us after trying 50 different things was handwritten invitations. Handwritten invitations, I literally had like 5-6 people writing out 100 invitations in nice script. Dear John, dear Mary, please come and join us. We'll have a great service for you. We'll do a good job for you. It builds trust that we care for you and all that in thick envelopes, like looked kind of premium. We launched New York. Okay. Did the same. We did it in London. We tried market fit in London. Thick envelope with handwritten note worked. Okay. We tried 50 channels, whatever. That worked. Copy paste in New York, same thing. Didn't work. We didn't get a single lead. Okay, what the hell's going on? We thought we were wrong. We thought it was kind of a different market we have to redo the market fit for that, for acquisition. Guess what? It turned out we timed it wrong. We launched that in the beginning of the summer when all the New Yorkers were out of town. People had second homes, left for the Hamptons. No one was there. We put stuff under the door. People didn't read it. So we made a mistake. So I'm just saying, if you chose at the time to focus on market fit and not on speed, you'd have stopped the shop and not continued with growth, whereas we were confident that we can do it. And I'm saying you should have the same judgment, but my view is that it's a judgment call. There's no science behind it.
Best way you found to figure out the market and research the market in general?
It varies quite widely. Like, for example, for Klevio, for the smart access thing, we had to look at a lot of property, structure of property. Is it a single home? Is it an apartment with a communal door and a private door? Is it what kind of structure? Is it a high-rise, mid-rise, low-rise, or is it a single-family home? So we looked at Eurostat. We looked at sort of local things in London. You have to scour the market. I would say Chat GPT-3 may be a good place to start to get some ideas about that. But there's lots of data in very unusual places, and also market reports which you pay for. So the hardest choice for us early stage in most cases was, do you spend $5,000, which seems like half the company's fundraise to get the market report. So generally I beg, steal and borrow. I call banker friends who have access to research and say, hey, do me a favor, that kind of stuff. You scrounge, you try to scrounge from people who have access to market reports. The other thing I was going to say, don't underestimate doing primary research, doing your own research. Because even if it's low numbers, it gives you much more direct evidence for something, especially for a consumer product. For example, tasting something. If you're doing a new drink, build a drink, go out with a tray, get people to try it. Okay. Same with a software product. If you want to give you feedback, get it out in the market. Get friends to test it for you, to use it, and give you feedback.
Thank you very much for the opportunity. Point 5 on your slide, you made mention of we surround ourselves with great people. How can one identify or surround himself with these people?
Look, in my experience, people who do great at this stage, at startup stage, are people who are comfortable with ambiguity. They're comfortable with change. They're comfortable that things change every day. You have one objective today, something changes, you have new data, we're changing course. They are okay with that. People who like a lot of structure and they're more kind of suitable for kind of larger, more predictable environments. So I feel that many of these kind of startup situations, when you have that mindset of kind of you're learning things and you're changing your mind then you tend to be okay. And that coupled with drive. When I say great people, remember, I'm not talking about a great individual. There's no good and bad people. There's people with certain sort of skills, attributes. You'll be great at something and terrible at it. There's many things I'm terrible at. Okay, doesn't mean because I've done sort of a startup and I'm kind of one or two things that it went well that I'm kind of a great entrepreneur. You don't hear this from people. People are great. It's a very specific thing. Things are very specific to specific people, and the best way is to try things out. I think you asked the question, how do you test for that? And the best thing we used to do is to bring somebody in for a day. Come and try out, work the phones, do some customer service, interact with people. It's the best way of gauging whether somebody could be suitable, right? But you can't always do that. In some roles, if you're hiring an accountant, you cannot come and spend 2-3 days when you have another job, you haven't left your job yet. It's complicated, right? It's also unfair on them. So I would say that great people is thinking about thinking actively, what skill set or personal attributes does your startup need to be successful? So if you're doing something which is very analytical, getting people who can concentrate for long periods of time or interact with you in an open way may be the best thing to do. If you're doing a hospitality startup, I want personality to be there as well. I want people to be able to go and face off with customers. So it varies quite widely, that set of skills. But the ones that I value, especially is drive and smarts, I think those things are quite in curiosity. It's important to have those things when you're doing something which has a wide range of outcomes.
Another perhaps a bit technical question, but how important is the valuation for a VC fund? Valuation of the company?
It's not important within range. So if you're talking about sort of market norms, look at market norms. Very rarely a VC will go outside the market norms, but of course now it's a weird time now, have a bit of a repricing of things now. Those are kind of like long-term ones every 7-10 years. I'm on my third kind of macro cycle now in startups. I've seen like the first dot-com boom and bust in 2001 was an absolute disaster. Things came off the cliff. I've seen also the Lehman's crash 2007, and now we're seeing the same thing where I say, things are not going to start repricing, but things do come back up again. There are ranges as to what's sensible and normal in terms of valuation and in terms of dilution. But when it comes to the first money in, like seed money, when the market is frothy, you could be worth 4 mil pre. If the market is not frothy, it's 1 mil pre. But guess what? The way to think about that, it doesn't matter, provided that sometimes you win, sometimes you lose. Sometimes you'll raise above the expectation of the valuation, sometimes you raise below. But provided you're on course, you don't really want to either underprice or overprice around. If you underprice around, then you get diluted. But if you overprice around, expectation goes up.
So from your perspective as the VC fund, then, would you ever reject the business idea because they're asking for it too high valuation?
No.
If you believe that.
Yeah, no. But if I see you negotiating on the valuation, I think I'm calling your judgment. I'm judging kind of, are you the right guy for this? If you're obsessed with valuation and you're not looking at product market fit, I'll say, are you the right guy for this? So I'm looking at other things. I'm looking at second order things. I don't care about valuation. Within range, be sensible and I'll be sensible. But the main thing I want is that do you understand why that doesn't matter? It doesn't matter within a range. It doesn't matter. Of course it matters.
How important is cash flow?
It's so important to the extent that founders are in continuous fundraising. This is like it's like you're always like a quarter away from death, and especially as you scale, it becomes more and more scary. It's like going to the casino and doing double or nothing each round. It's like it feels like that because as you scale, the stakes become higher and higher. You have more people, more burn, bigger rounds. It's a leverage bet, but ultimately, it's important to have enough cash to know that you can adjust something. In my experience, you cannot adjust, post Series A in a big way. If you've locked in the market fit and the kind of your general model, you can do something. You can pivot. It's much simpler to pivot before you raise a big round. Much simpler to pivot at seed stage. If at seed stage doesn't work, down tools, tell the VC, sorry, we're changing course. That's fine. It's respectable, acceptable. People respect you for it. But don't change course at Series C, having raised 50 million value. So I'm just saying that cash flow matters in the sense that you need to have enough leeway to pivot. So think about kind of your cash flow as being, what bets can I take to get to market fit, and how many lives do I have? It's like playing a video game. I have 3 lives. So your cash flow is like your 3 lives. Am I 1 down, 2 down? By the time you're on your 3rd life, it's your last chance. So start either raising because people trust that you're going to get another chance at market fit, or just say, sorry guys, it's not going to work. Giving up. But yeah, it's terribly important. I see a hand. No? Anyone else? No?
Okay then, thank you so much.
Thank you. Thank you very much.